15th Portfolio Builder Profit Loss webinar, where we'll cover charts, news, exact investment strategy, and more. This is one of our best months, if not the best month in the history of our advisory service. Our high risk, high return portfolio is now up 21% in October. The Warren Buffett strategy, which we call Safe Alpha, is up 12% in October. The Ray Dalio Safe Growth Pro strategy, really good for large amounts of capital, 7 figures, 11% in October. And then the Bootcamp Core strategy, betting big on Bitcoin, having a field day with the news of an ETF coming in the very near future, trading futures markets up 16% in October. So great returns. Now, if you're taking a free trial with Portfolio Builder, we want to welcome you and give you a special thanks. You're only going to have access to the formula for our high risk, high return portfolio, which is out now up a staggering 277% year to date, outperforming the S&P 500 17 times. Current recommendation is buy any one of the 4 strategies. What I'm expecting is the dollar is about to fall in value as stimulus passes by mid-December and markets rip higher. There's a few things to watch out for, namely tapering could cause some volatility November 3rd. And if we don't get the budget passed by mid-December, then all bets are off. So those are 2 critical risks that we're going to update you on twice a week during this live webinar. Now, if you want a walkthrough on how to follow the strategy or a customized trade alert, call John. He's working the weekend. We've got John from Friday through Tuesday to service you, and then Dean Tuesday through Friday. So we're offering support to people on a trial 7 days a week. Now, John's phone number is 505-610-1334. He can walk you through the current trading plan, customize a trade alert screenshot for you, and answer all your questions. Okay, so we gave out a few predictions on Tuesday, October 12th. 5, in fact. We're going to review those predictions and see how they're playing out thus far. So on Tuesday, I estimated that the CPI core inflation would fall slightly Wednesday, and that mandates will cause weak jobs growth in October, leading to no Fed tapering November 3rd. So far, I'd say we nailed it. The CPI did come in flat rather than go up at 4%. So I'd say that was good. Now, if you're looking at the PCE, which includes food and energy, it actually did jump to I think it was a 17-year high. There's a lot of pressure to try to fight off this inflation. But right now, retail sales came in up 0.7% today. So it's going to be a very mixed bag to understand whether or not the Fed's going to taper or not. I think we may see them delay the call to December and see just how the labor markets are behaving. But right now, sales are up, corporate profits are up. So those are the main things we need to focus on. Okay, prediction 2. If the Fed does taper November 3rd, which they're saying is very likely with news, people that they leak the news to, like Bloomberg, Yahoo Finance, you name it, CNBC, even though FOMC minutes were saying either November or December to taper. But is this going to come at a really bad time as the economy is slowing down? People who are getting free money from the government are now 2 weeks out of the free money, probably looking for work and starting to run out of capital. And we're potentially going to enter a lot of supply chain shocks and all sorts of problems as we enter November, December. So I'm not so sure they will taper. If they do, will it create volatility in stocks or bonds? I think so. So we'll see how that plays out and see what sort of hints they're giving as we approach November 3rd. Okay, prediction 3, stocks, cryptos, and commodities melt up higher until December, especially if labor and growth are weak in October. So far that's playing out and why we have such remarkable gains in all strategies. Prediction 4. This is a big fat maybe. I believe Jayapal and Manchin will agree to a $2 trillion stimulus deal by mid-December, and that they will shorten the time frame of the spending so that even though the headline is not the $3.5 trillion, which Manchin opposes, it'll still be the same amount of spending per year, just with a shorter time horizon. That's going to be critical to how we play the markets. If it looks like they're not going to come to terms, then we have a huge problem on our hands. But I do believe the market will be patient till about mid-December. Prediction 5, Bitcoin hits 100,000 and oil hits $100 by March 2022 as tech flatlines or falls. So I'm expecting rates to rise, oil to go up. I think Bitcoin's going to overlook the interest rates rising. And so we just had Bitcoin jump above 60,000 overnight, currently at 61,746. We're loaded to the brim in Bitcoin with Bootcamp Core. If you follow my private equity offering for Rebel Dividends, I was predicting Bitcoin would lead the way up, then Ethereum would chase, then altcoins fall in line after. And so far, that's exactly what we have. We have Bitcoin up 7.5% in the last 24 hours, with Ethereum up only 1.9, and most of the altcoins not doing a whole lot except for Polkadot. Okay, so at the end of this video, I will review the asset allocation breakdown and detailed monthly profit loss breakdown of each strategy. So stay tuned at the very end for that. But if you're expired and catching this on YouTube, I'm sorry to say we do cut that off. That's only for paid members if you want to get the exact formula for success. So again, if you're on a trial or you're expired, give John a call at 505-610-1334. He can walk you through our product, our services, and if you're on an active trial, give you a customized screenshot so you can get your money to work right now. Okay, so real quick, what are the key market risks to focus on and how do we adapt our strategies? So there are now 7 million Americans who lost unemployment benefits. Will they return to the workforce in October? We had a record number of jobs quit. The number of openings did fall 500,000. But so far, we're not seeing these people go back to work. Will it occur? If it is going to happen, I believe it's going to happen in October and early November, as I'm actually anticipating a new wave of the sickness really slowing down the economy into winter. And then throw on top of that supply chain issues. So record number of people quit their job, 3.5 million. This is signaling that wages will likely rise and continue to pressure inflation. So now I will point out that the inflation data was highly skewing the inflation on rent, way less than the reality. So I think these inflation points that the Fed is putting out, or the government's putting out, are way below the true inflation. So there's going to be a lot of political pressure to fight this inflation through monetary policy. So we'll see what exactly happens November 3rd. Another thing that's spreading is the call-in sick. So we had airlines doing this. We've got basketball stars fighting against the mandates. So this, we've got police forces fighting back. Much of the army is refusing these mandates. So this could be very, very problematic for the economy and labor markets, which again is good for the way we're currently positioned. And the biggest risk, in my opinion, remains that the government fails to expand its debt, and that this has a deadline of early to mid-December to complete without creating volatility. Now, could we have a lockdown in the US starting in mid-November? I think there's a high probability that we will see the hospital systems getting overwhelmed. And if there's not progress on the spending package, that lockdowns will be used as a political weapon to help pressure markets and the Senate and House into passing legislature and spending. And then furthermore, we now know without question, the medicine being used to fight the sickness is going to wear off and not be effective for the majority of Americans exactly when we have seasonality of a lot of people getting sick and hitting the hospitals. So I'm quite confident that that's going to, at the very least, raise some eyebrows and be an option to help pressure politics. So bottom line, the September sell-off was likely a prelude to a larger potential crash, most likely I'm thinking in December, if the debt ceiling and new spending continue to be blocked. So McConnell gave the Democrats a bone, $500 billion to delay the same problems we had in September. Let's see how this plays out. Not a lot of news on that front yet. Now, failure to close a deal in December would likely cause a stock crash, and our UVXY VIX position protects us against this with potential 1,000% gains. And there's just a look at UVXY last March, where we did accurately predict the crash, and you can see UVXY went up 1,100%. So it's a beautiful product. I've been not adding to the position for months, anticipating the risk to be right around late November, early December, and potentially November 3rd if they're going to try to taper. So we may increase our hedge slightly at the very end of October, and then potentially get much more defensive if there's no progress on the spending by late November. So we can slowly ease into a more defensive strategy. Okay, so the bad news keeps coming out of China, but I want to remind you, Chinese imports and exports are at record highs, I would say, by the dip. So when their economy is really strong, they're trying to take out bad debts in their economy, and it makes sense. So that's why I'm not freaking out about the Evergrande stories. We do know that real estate's a massive 30% part of China's economy. But in general, I don't think they're trying to destruct their economy just to fight the inflation, pop some bubbles while their economy is red hot, and be in an advantage for the coming decade. Charlie Munger, Buffett's partner, doubled down on Alibaba. And again, we already have great exposure to Alibaba in the pro Ray Dalio strategy with EDC and in the Bootcamp core strategy with FNGU. So again, it would be very ironic for China to crash global financial markets in an effort to clean their economy on the back of their best year economically ever in history, as they are looking at taking over the most important economy in the world within the next 1 to 2 decades. So Chinese real estate bond defaults continue to hit the headlines. Now the CCP is cracking down on its own banking sector. When will the smash and grab by the CCP end? We have to just carefully watch and see how this plays out. Dollar index was as high as 94.50 this week. It's down to 94, and I think it's getting ready to fall. Brent, so that is one line in the sand that would get us alert. So that has started to ease off of the highs and coming back down. So the returns we've had with the dollar going up are phenomenal. Just wait till that dollar falls, which I'm highly confident is the long-term play for the dollar. Emerging markets going below 48 would be a problem, but we have EEM at 51.90, one of our best performing assets this week for the pro strategy. If Brent oil were to go below 75 and the dollar were rising, I'd get upset and get defensive, believe we have a crash coming in. Instead, Brent oil is at 84.29. If the Chinese currency were devaluing towards 6.6 or higher, I believe we have real problems in China. It's just remaining ultra strong at 6.4. So the reality is there's nothing to make us believe we're on the verge of a crisis in the very short term. So there's your dollar index. Again, you can see it's gone up to a critical level. I believe it's going to fall, and our portfolio is going to be highly benefited from that. Here's a look at emerging markets. Again, this screenshot was from Tuesday. Since then, emerging markets has jumped up to the 52 level. Here's a look at the TLT. Okay, now again, if the bond market were crashing, that would be another problem. As interest rates rise, it destructs markets around it. And right now, the TLT is just trading relatively flat, a little bit down, but it's been going up and down and up and down at 144 today. So it's actually had an easing in interest rates since Tuesday. So no reason to get all worked up. Here's a look at the Chinese yuan. Again, just trading very strong with nothing to become alarmed with. Here's oil from from Tuesday. It's gone up another $1.25. So we got the dollar and oil going up. No reason to become alarmed. Now, if a true recession is coming in and not mere market manipulations due to politics, I'd expect oil and other energies commodities to fall. Instead, they're just going higher and higher. Coal in China is hitting extreme highs. So yeah, the big picture is energy is roaring to unsustainable prices due to high demand. So watch for a sudden crash in oil prices to predict a deflationary spike. And so far, we just don't have that. Now, shipping prices and times remain at record levels as well, but they have cooled off. Are they getting ready to go to new highs as we approach winter? A lot of people are predicting that just very well may be the case. So the big picture is there seems to be a slow but steady reboot of global economies as the sickness slowly becomes less and less of a burden on society. My core prediction remains that we have a slow motion, multi-year rotation out of growth, which would be your tech giants, your FANG stocks, and into value, primarily the people producing the commodities. And specifically, I really like the oil play, but we also like rare earth metals, we like copper, we like uranium. So all these hard assets. Big picture, expect a 3 to 5 year bull market in energy companies, and that's how we can hedge against interest rates rising. Here's a look at these cycles. So you have the dot-com bust. It took them a year to expand deficits. So by 2002, the markets began to rebound. Interest rates rose all the way to the financial crisis, and your best hedge against interest rates or inflation was to bet on the oil and gas companies who benefit from expensive oil. So XLE had a massive 300% return for 5 years. Eventually, inflation created unsustainable prices that crashed the economy, and they doubled the deficit spending much faster this time, bailed out the banks, began doing quantitative easing. And sure, they tried to taper here and there, and it was quickly rejected. But you ended up with a 7-year cycle this time and over a 400% return in XLE. Now, the second they had a populist agenda come on board, oh boy, they started to tighten monetary policy and all sorts of negative effects on the economy. And XLE certainly didn't like that, led to a crash in 2020. And here we are again, ramping up deficit spending, suppressing interest rates, and now entering most likely a multi-year bull market in commodities. So this is going to be a very important position for us for several years. Now, what should we expect when stimulus passes? I would expect EDC, emerging markets, EEM times 3, EFO, Europe times, which is EFA times 2, to outperform UPRO, which is the S&P 500. So we think Europe and Asia are going to greatly outperform North America over this next cycle, which will likely be about 10 years. Here's a look. Last time we did pass stimulus, and you can see the SPY had a 19% return, emerging markets up to a 30%, and European up to a 25.5%. So you can see that outperformance when the US is growing its deficits. We import all our goods, so foreign countries benefit from that. Big picture though, get ready for rates to rise and potentially another growth to value rotation. Here's the last time it occurred where interest rates went up too quickly. The yellow line, energy companies in green did really well. Tech stocks had a fit and sold off. Then what happened? We didn't recover the economy nearly as quickly as promised, which was supposed to be 1 million jobs a month. And what's happened since then is the economy has grinded to a very slow they're now predicting GDP Q4 has gone from 7.5 to 1. So we'll see how this all pans out. But bottom line is we're likely to pass 2 trillion in stimulus by December and repeat what happened early 2021. So we're prepared for that. And in other words, right now may be the very best time to start following any one of our strategies. As the dollar falls, our portfolios are all set to benefit from this. And if they don't pass the stimulus, this will be the webinar that tells you when to get defensive and exactly how to do it. Okay, so very good. We're going to hop into some charts and news now. I'll do a quick shout out to the live crowd before we hop in. But reverse repo is now at 1.4 trillion. That's very bullish, especially for tech. So I'm not telling you to sell your tech just yet. Okay, so calling in live today, we have A. Tafor, Arif Dean, Clint, Dan Johnson, David, Dean, Don, Ed, Eddie, Eric, Fred, Gary, Grace, JD, Jeff, Jenny, Jody, Joseph, Nell, Larry, another Larry, Orlando, Manra, Michael, Middley, Joseph, Murray, Neil, Oscar. Oh, Oscar's back. So welcome back, Oscar. Everybody's been asking about you. Poor Oscar got really sick, but he's back on his feet. And we're glad he's doing okay. Pat, PRP, Rick, Ron, Tom Sharp, Tariq, Terry, Tor Peter, Vestura, Victor, Walter, and Wendell Wells. So thank you guys all for joining us live. If you're catching the replay, hope you're having a great weekend. So we haven't looked at this in a minute, but let's take a look on the yield curve. So yield curve is something that's used to predict recessions in general. If this is not having higher interest rates, the longer you borrow money, it tends to predict some problems in the economy. So very, very interesting. The short-term duration products are extremely low. And then you can see the cost to borrow money goes rocketing up the further we go out. So banks want the risk-free T-bills, really, the short duration debt, so they can service all this money stored in their banks where they have to pay interest. And they're not so happy to buy the long duration debts because inflation's at 4 to maybe 8% right now, and you only get paid 1.5 to 2%. So it makes a lot of sense. So we'll wait for this to become inverted to make too much of it. But what's going to happen if they start to reduce the bond purchases, which they're saying is going to be 10 billion less a month on treasuries and 5 billion or less on mortgage-backed securities? Are rates going to rise, or is the market going to predict this will crash the economy and push rates lower? I'm not 100% sure exactly what the reaction will be if they start to taper November. But I would estimate either rates rise and our NRGU position goes up, or the markets have a fit and stocks go down and our UVXY goes up. So we've got the two important hedges in place based on this risk of a tapering November 3rd. Okay, so we'll spend more time on this as they start to stop manipulating it so much through quantitative easing. Next chart we're going to look at is the VIX futures curve. So we're looking at specifically where do the dots jump the most. This is telling us where there's hedging going on and a potential risk of a crash. So we can see from October to November, there's a large jump from 17 to 19.8. Which is about a difference of 2.8. For the next month, it's much less. From November to December, there's a significantly smaller jump. And then the next big jump, which is about 1.5, is from December to January. So you can see the market's primarily worried about a crash between now and January, with the key events being tapering November 3rd, and then potentially tapering December if they don't taper November, and then again, failing to pass this stimulus. So after that, the market's much more relaxed, and there's not a whole lot of hedging going on. which is exactly what I see as the current risks as well. Okay, we're likely not going to get a big crash in anything if the reverse repo is at $1.4 trillion. This means banks are fighting over US debt products. So there's very little chance that interest rates are going to rise substantially, which we do think is the most significant risk outside of the government not issuing debt, which I find unlikely when they control the House, Senate, and Oval Office. So we'll see how that plays out. But no reason to freak out and dump your tech stocks. Those are likely getting ready to make new highs as we approach Christmas. Okay, so here is the core of our entire strategy. We look at growth and value as the two main assets, and that interest rates are going to be what causes these money flows to go either to growth or value. And so in the gray line, we can see, let's just take a look at that. So if we look at this period of time in gray, you can see those interest rates went rocketing up as we passed stimulus. Tech stocks took a dump, energy went up. Unfortunately, the stimulus did not fix the economy or get anybody back to work because we had all these benefits paying you to stay home. Rates went right back down, predicting low growth. Energy bobbled around, had a huge crash, and tech stocks went right back up. And so now we can see markets are clearly predicting that there will be a big package passed and that rates are going to rise. And so that's exactly how we have you positioned. And we've had a massive return on NRGU since the bottom right here in August. I think we've more than doubled our money on that. So I know you guys probably upset that I had us get in April, held it, it came back down on us. Everybody thought this was going to zero. I said, hold on. You think we're going to increase demand for oil or reduce it as economies reopen? And clearly we're going to need more oil. And by understanding the macro view and ignoring all the noise, sure enough, here we are. So very good to everyone who's following the strategy. Okay, Russell 2000 has been made a famous indicator by a very great investor named Stanley Druckenmiller. Russell 2000 has been trading flat for the entire year, not giving us a signal in either direction. Okay, so my bet is we pass stimulus, Russell 2000 goes higher, as well as the stock market. Emerging markets has been a painful trade for the majority of the year as the dollar's risen and the stimulus has dried up. But are we on the verge of China easing policy, stopping all these crackdowns, and the US is about to pass trillions in stimulus that benefits foreign countries? I think that's exactly what's about to occur. I love emerging markets for that reason. Okay, the other index we're playing is the European market, EFO. This is loaded up with retail and banks. And so perfect for an inflationary rising interest rate environment, which I think is going to be the case for many years. And so very good setup here. Jeffrey Gundlach's been hyping up to add to this index, while Ray Dalio and BlackRock have been hyping up to add to emerging markets. And now we're seeing even Warren Buffett start to go to China and Japan to find new investments. So the writing is on the wall. Okay, we love Ethereum and Bitcoin. In our Bootcamp core, we're big on Bitcoin. And in our high risk strategy, we're big on Ethereum. We have to zoom in, but you could see for a tiny little bit of time here, Bitcoin's outperforming Ethereum on the news of an ETF coming in. So it's a ETF for futures, so it's not as good as an ETF that would buy the underlying and helps out all these middlemen involved in all of this. But in general, more money can now flow into Bitcoin via an ETF. I find this is good news. A lot of people are trying to say every time an ETF's been issued, it's had the rug pulled from under it and people lost money. A lot of them are pointing out to 2018, but that's exactly when we started to raise interest rates. Okay, so that's what caused the Bitcoin crash 2018. had nothing to do with ETFs. Big picture, Ethereum is smoking Bitcoin. So I do think you'll get a better return over time with Ethereum versus Bitcoin, but that's the nature. Bitcoin leads the way, Ethereum comes in next, and then we get the altcoins. So here it comes. Get ready, get excited. If you're in Rebel Dividends, we're set up for this. If you're in Bootcamp Core or high risk, you're set up for this already. Okay, what's going on in gold and silver? Boy, they do not like the rates rising, and Bitcoin seems to have stolen a lot of their fun. So keeping a close eye on that. But very interesting to see the lack of performance of these supposed inflationary hedges, gold and silver. So currently, we have a small position in this in Safe Alpha and a really small position in silver for Pro. Okay, on the defensive side, the products that we like are UVXY. That's out of the money put options on the S&P 500 that automatically roll over. Beautiful product if you want to short the market without having to be an options or futures trader. Love it. We've not added to the position. We're very light on UVXY across all strategies, and I do intend to buy into UVXY probably closer to November 3rd in case the tapering causes volatility, and then probably again towards the end of November, assuming we don't have really good news coming out of the House and Senate relative to passing more stimulus. TMF is treasuries. If we're going to fail to pass spending, there's going to be a shortage of treasuries globally, which banks desperately need to safely pay interest on deposits. And after the world printed tens of trillions of dollars, the banks are flush in cash and they have to service this debt, these deposits by buying bonds, collecting the interest, and giving it to the bank depositors. So this could go parabolic. UVXY could go parabolic, and the dollar could go up if we fail to pass spending this December. So EUO bets on the dollar versus the euro. I wouldn't enter that one right now. I'm actually thinking the dollar goes down until the event horizon, which would be mid-December. And then again, I wouldn't be long treasuries while oil's skyrocketing. That tells us rates should go up and that they're just hanging in there due to demand from banks. And we can see the banks aren't so happy about buying the long end. They're mostly fighting over the T-bills because there's such little risk and it covers their costs on the servicing of debt, of deposits, excuse me. So those are the three plays. You can get 10 times return with UVXY. We could probably make 2 to 3 times return on TMF and maybe 30 to 50% on EUO if we get a crisis, which I believe would probably happen most likely in December, and a big maybe if they taper in November. But I'm not so sure we wouldn't just get NRGU going up with the tapering. Okay, now we have a few special plays for our Bootcamp Core product, which are uranium, which we've been out of. I'm getting ready to enter that and probably replace it with our MJ play, which has been really boring. We've got FNGU, that's the NASDAQ plus Alibaba and Baidu. So really like that product. And again, it's not the entire NASDAQ, it's just a hand-picked selection of 12 companies. So that one's really done well. TAN starting to get a bid after a really nasty pullback all year. That's your solar panels. And then REMX provides the lithium and about 34 rare metals that tech companies primarily need to create their goods and services. I love all of these products for several decades to come. So it's a great set of assets to be long. And we're starting to see a nice bid on most of them outside of this MJ, which continues to just be such a dud. But MJ, you can see, can have some extreme returns here. So we're still being patient here. Maybe the stimulus will get the stock promotion capital they need to pump that industry, because the fundamentals on all of these continue to get better and better. Okay, there's our dollar index. Again, I think we're going to pass stimulus and it's going to come right back down. And that's perfectly how we're positioned currently. The yuan, again, no signs of devaluing the yuan, which would signal problems from China that are out of the control of the government. We have reviewed the energy cycle. Here's a look at the cryptocurrency boards. So a bunch of headlines coming out of Ripple. I guess they're adding smart contracts and NFTs, and they're potentially getting through the SEC fight. So we'll see. I'm not a super big fan of that one. We can see Bitcoin's been leading the way. Binance Coin is up 9%. We don't have a position in Ripple or Binance Coin at Rebel. For Portfolio Builder, we just have Bitcoin and Ethereum. The other coins I'm very bullish on, and I believe are a great hedge against owning Bitcoin or Ethereum are to play Cardano, which just released its smart contracts. I like Solana. This is pushed by the big VCs out of San Francisco, and then Polkadot. Other plays we have that I'm a fan of are Polygon, a solution to make Ethereum more efficient and to help you get money between Binance and Ethereum. And then our last play that I really like is called Cake. And that one is actually the DeFi exchange for Binance. So the headlines that Binance is getting kicked out of all these countries is great news for its DeFi exchange, PancakeSwap, which offers a 70% staking reward. So those are my favorite plays in the crypto space. And again, if you're interested in that, give us a ring. Okay, let's look at the returns of some of these cryptos. Polkadot and Polygon have been leading the way this morning. If we zoom out a bit, we can see Bitcoin since October 1st is up 40%, Polkadot up 45, Polygon 31. NRGU is our interest rate hedge to protect those cryptocurrencies, up 30, Ethereum up 28, Solana 13, Cardano 5, Cake 4. But remember, they pay out a huge staking reward, so it's a pretty safe bet on that one. Okay, so check it out. Most medicine state in the country having some pretty odd data coming in. These are cases. So yeah, it's very clear. There is a significant risk of lockdowns coming into winter without question, especially if the politics aren't going the way that they need. So very, very interesting. This is also happening in Singapore. Pretty much every location globally that has the highest level of medicine after 3 months has massive breakouts. So the response to that's typically is it could have been so much worse. Israel, we were watching closely, anticipating it should fall. It has fallen. So I think they're now getting ready for a 4th dose, 5th dose. But it just goes to show they completed the medicine in February. 6 months later, medicine wore off and huge outbreak. So this is not super hard to predict what's going to happen in the US here. A new example, Singapore. I think they're close to 95% taking the medicine. And again, just doesn't work the way that we were believing it would. Okay, rate of change of the sickness is crashing. But again, that's exactly the seasonality. Get ready for winter. By mid-November, we're likely going to have some big problems in the medical system, especially because we're creating labor shortages due to mandates. So boy, oh boy, this could become problematic. Here is the seasonality, and it's by mid-November, you're getting to levels we actually have right now. Now again, relative to last September though, much lower. So this could be potentially by late November to early December, we could be seeing some record levels of hospitalizations. So we'll see if that plays out. I believe it will. Now, if you thought it was the mutation of the sickness that was getting around the medicine, explain this. So UK finished its 2nd dose of the medicine in June for the majority of the population, and then reopened as the mutation was spreading and the media was going hysterical. UK was going to have a meltdown, but sure enough, no. The data all just crashed and the medicine did its job. But again, that's because they had just got the second dose right as they reopen. It looks like you get about a 90-day window of high efficacy, the medicine, and then it falls off a cliff and potentially doesn't work whatsoever within 120 days. So that's what we're looking at with that risk. Long term, maybe this is the last time we have to worry about this winter, and in general, it's going to become background noise. India, of course, did not have the means to get the medicine to their population and did just fine and continue to do just fine. Now, is the medicine blocking a real immune response and making people become reliant on this medicine long term? Maybe. That's something we will get better data upon after this winter. It's starting to look like that is indeed the case, though. So all of this just really adds to a poor economy, and essentially the government's going to be stuck growing deficits. The Fed's going to be stuck keeping interest rates lower, and this inflation play keeps playing out. So if you're a crypto fan, bravo, we like all this bad news. Okay, here's the conundrum in the markets. We got rates staying flat, oil going up. These two are typically tied to the hip. Oil will predict a crash way before it occurs, and I believe that will be the case again. So I don't think we have a crash coming right now because oil keeps going higher. And so I'd be very fearful if I was holding bonds right now. Your only chance for bonds to go up in the short term would be a failure for the Democrats to pass a budget and create a new government shutdown, which won't happen at the earliest till mid-December because McConnell gave them $500 billion of extra debt issuance on a nice silver platter for them. So we'll get worried about that as we approach December. And my best guess is the tapering is going to make our NRGU position go up and not crash markets because we need the real item that would crash markets is government slows down spending. Okay, let's look at some of these commodities, futures, products. Natural gas was just going out of control. Europe having huge problems. People are probably going to start switching from natural gas to oil as these costs have gone just nuts. So that's great for the way we're positioned. Dr. Copper made this melt up in the last couple days. This is exactly what we're predicting. What about lumber futures? Well, starting to rip higher again. So what's the cause of the cancer? It is the government spending money. What's going to cause these trends to change? The government slows down its spending. No sign of that. Baltic Dry Index slowing down a little bit. Shipping costs and timeframes are slowing down. But is this about to pick up during the holiday demand season? Probably. We've got ships stuck outside of California. So very, very interesting problems developing here as we come to the end of the year. Okay, here is the 10-year and 30-year bond. My best guess is that bonds are going to slowly crash for several years. Well, I actually think it's going to peak out in 2023. And I believe that we'll see the 30-year hit 2.8 to 3 at an all-time high for 2022. And we want to aggressively buy bonds at those rates, realizing the economy cannot handle that. And we're going to have a meltdown in financial markets due to these interest rates becoming so attractive. And likely we're going to have the Fed tighten after midterms in early 2023 to try to kill off the inflation and set us up for more quantitative easing, more stimulus into the 2024 election. So I wouldn't be holding bonds right now. You're probably looking at a 30% loss from here. And the only hope for these to go lower would be the government fails to spend money, which they have a pretty good track record of spending money they don't have. And they control all three houses of all three branches of the government, for heaven's sakes. Now, how out of control can this interest rate problem become? Well, just look at this copper to gold ratio. They call it Dr. Copper. This predicts rates. Now it's a little delayed. We know those copper prices are going up as gold goes down right now, so it's going to jump back up. But we could be at the very beginning of this commodity interest rate cycle, and it could last for several years. I think it'll take a pause in 2023 due to politics, and then keep going higher beyond that. Okay, here's the credit markets that can cause some problems. In general, if any one of these three were going down sharply, that would signal credit issues. And so right now they're not. So TLT is your US government getting funded. LQD is the investment grade bonds, and JNK is feeding all the IWM stocks. So all of them have access to capital, nothing to freak out about there. This is where Janet Yellen can raise money, and she just got approval, I think last night actually. Biden signed the package so that they can have an extra, I think they called it the Health and Exercise Act, something bizarre. But bottom line is now Janet Yellen can sell another $500 billion of debt to keep the government funded through December. Just amazing how much money we spend per month, about $300 billion a month. So as long as reverse repo is at 1.4 trillion, we're not going to believe any amount of debt Janet Yellen wants to issue is going to crash the bond market and cause us problems. Okay, this non-farm payrolls came in hot today, 194,000. So that's good news on the labor recovery. So we'll see how this plays out. 7 million people now are not getting as much money from the government. Are they going to run out of cash and go find a job? This is the time for jobs to grow right now. So if October has huge job growth, and maybe November as well, perhaps we begin to taper in December. I'm thinking the Fed's going to delay it 1 month at least, because they won't know the jobs data when they have to make the call on November 3rd. But retail sales went up 0.7% today. Non-farm payrolls went below 200,000, a really beautiful print on that front. So all that remains is jobs coming back online, and then pass some more stimulus, and then the Fed will have to start tapering. Here's that core inflation data. So this is the one that does remove food and energy. Now they definitely have made the rent look way lower than it really is. So I think rent and wages are going to push this back up starting next month, almost certainly. This is pressuring the central bank to tighten monetary policy. So a weak print, this would lead to us to believe maybe they'll delay that call November and make sure we have labor growing. Okay, credit in banks is growing. That's good signs. Consumers keep borrowing, even though at a slightly smaller pace. Bank of America actually got retail sales wrong for the first time. They had predicted this like clockwork for last year. They thought we were going to have a drop. We actually had a jump, and that was all in today. So interesting on that front. Here's a look at the consumer spending. So why are stocks going up? Earnings are going up, and consumer spending is going up. So when is the consumer going to run out of money that it was collecting from the government and show a drop? That's a good question. Not yet. Okay, job openings did drop slightly, which we reviewed last Tuesday. Producer prices are going up. No signs of easing in the input cost to companies. In China, it came in at, I think, 9.5. There's a chart overlaying coal prices in China relative to PPI, signaling their producer price inflation could go to 20%. If they start to pass that down the food chain, cost of everything's going to rise. Is it going to squish profit margins? Is it going to slow down consumption? That's yet to be seen. Okay, wages are starting to rise. This will begin to pressure that CPI higher. Labor force participation still at very low levels. If we're going to believe that the economy can handle high commodity prices This needs to be going up, and we can see it's slightly up, but nowhere near where it was before the lockdowns. So let's see this start to march back that way. A lot of people are retiring and saying, you know what, I've made so much in my stock portfolio, I'm just going to call it quits. And yeah, so we're seeing big problems getting labor to return to work right now. Balance of trade hit a new high. This is a few weeks old, but when you run big deficits and you buy all your goods and services from foreign countries, it weakens your currency over time, and that's exactly what we're betting on currently. Okay, so personal income rose 0.2%. Obviously, that's nowhere near the rising inflation. Apple's a canary in the coal mine. They just slashed their production estimates due to chip shortages. So interesting problem developing in all sorts of sectors. I think there's a few car manufacturers planning to shut down factories due to supply chain issues. Here's Tesla rocketing up. Remember Michael Burry tried to short it right here. So that was a terrible bet for him. As far as topping out on Tesla, I believe the likelihood of interest rates rising will be after stimulus is passed. So I'd get worried about Tesla after stimulus passes in what I believe will be mid-December. So ARK Funds has been dumping Tesla. Kathy Woods keeps going online saying that the next problem is going to be a deflationary shock. I think she was telling us oil is hedged at 25 a few weeks ago or a few months ago. So yeah, her strategy is probably going to have a very problematic period of time till 2023, when we crush the economy with monetary tightening and then go back into hyper spending at the government. So this is definitely a big risk to markets because there's so much money tied up in all of these projects that don't turn profits and don't like interest rates rising, which I believe is the primary trend till 2023. Okay, Tencent is big in our EDC portfolio, a huge software company out of China. Critical this stabilizes, and it is, so that's good news there. Same thing for Alibaba. Again, smash and grab by the government, in my opinion, totally political manipulation. Okay, Samsung starting to get a bid. This was probably the scariest chart of any company that we're following currently. And then we got Toyota just doing great. So at this point, we're not freaking out and increasing hedging. Okay, China's PMI is growing again above 50. European PMI is still way above 50. Chinese imports just hit a new record level. So it makes sense that they would try to clean up their economy on the back of a strong economy. And then the same thing for their exports, signaling that there's still a lot of demand globally. Okay, on the Chinese inflation, they say there's essentially none, but their PPI is above 10. Coal prices are just skyrocketing, so that's obviously not very reliable. The Fed continues to print. Are they really going to slow this down at a rate of 15 billion a month and be done by late summer next year? We will see. But you're going to need a strong economy to support that. Europe's signaling the same timeline, but yet they've continued to print. And over in Japan, they have slowed down. And we've actually heard Bank of England getting ready to raise rates. I think there's a small emerging market country starting to raise rates. So we're starting to see governments want to fight inflation by tightening monetary policy. Okay, let's hit the news and then we'll review our asset allocation. So container shipping rates starting to fall a little bit, but is this going to pick right back up as we head into the holidays? Probably. So keep a close eye on that. But this is a signal of weakening demand. Interesting data out of the UK. The folks with medicine are having a higher rate of cases. than the non. Is that maybe just because people have taken the medicine, assume they're safe, and they're interacting more, perhaps? Either way, this is not what we expected or were told. So we have to forecast how this will impact economies. Here's that Chinese data point. So we've got the Chinese PPI hit 10.7 today. That was the new data point. Sorry, I said 9.5. But they're overlaying it to coal futures, and coal futures are up at 40. So wow. So yeah, if these prices start to get pushed down the line, you could see some serious inflation problems. Excess deaths year over year are up globally. So I'm trying to figure out why exactly that is. Could it be due to not being able to take care of a lot of people how we should have over the last year? So not making a whole lot of that. This chart's looking at GDP globally relative to global stock valuations, saying it's about 40% higher than trend. So we'll see how that plays out. Kraft Heinz CEO says consumers need to prepare for permanent increase in food prices. Italy's issuing a mandate to almost all sectors of the economy to have your medicine. So very interesting. That's creating all sorts of protests and probably slowing down economies globally. Peter Schiff is pissed that his gold is not behaving how he thinks it should be. I do like to listen to his podcast. I highly recommend that. Maybe don't necessarily take his trade recommendations, but okay. Live Monitor says Brent will go over 100 as people switch to oil for power due to natural gas getting so expensive. Expecting 125 by spring. So it's a little bit higher than my target, but we've been betting on that for quite some time, haven't we? And it's paying out. This is a chart looking at the lack of energy investment. And so essentially, we're going to have a lot of demand for oil and not enough supply. And the companies who have access to it are poised to do very well from that. Now, again, if we could replace oil with other sources of non-renewables, then maybe this wouldn't be the case. But, everywhere in the world that's been trying to do that has the worst energy shocks right now, and it's clearly not working. Just much more difficult to occur. Okay, so this was looking at the CPI's inflation compared to the Fed's and or the government's CPI, and they grossly underreported the rent inflation and used car inflation. A Australian pension fund announces they might make a small investment into cryptocurrencies. So good news on that front. Whitney Webb saying that we're going to start seeing the lockdown narrative switch from the sickness to climate change. That the main goal here is to reduce carbon emissions and keep you at home. Use the internet to reduce carbon emissions. And so here in Australia, they are now starting to switch to that narrative. She's a very good investigative journalist. Definitely recommend her content. We're seeing certain states fight back against the mandates. All of a sudden, we were told that OSHA was going to enforce all these mandates. And now it's completely off the radar. Where's the OSHA mandates? Not here. Now they're saying some other branch is going to do it. Looks like there's really no real mandate coming. Just PR announcements. We'll see how that plays off. We've got a climate change summit happening, and I guess China's not going to attend, so make of that as you will. Excess mortalities everywhere is up significantly this year, raising some eyebrows. This is just a funny clip if you want to watch it. Narrative started off that the medicine has 100% efficiency, and 3 months later, we have them reporting as low as 35%, or that it doesn't work at all after 3 months. So FOMC minutes released this week essentially said that either November or December makes sense to taper, that they would reduce treasury purchases by 10 billion and mortgage-backed securities by 5 billion per month until they got to zero. And again, I think we need to see a pretty strong jobs number to the retail sales does make me question whether or not they'll taper, and the oil going up so fast. So we'll see if they have the guts to do it November 3rd. We're prepared with UVXY or NRGU. One of those will likely go up, is my bet, if they taper significantly. So we'll probably, well, NRGU has already doubled for us, so I don't see us needing to modify that much. UVXY has obviously been crushed, so we might add to that as we get closer to November. Some of the bond bulls are having a fit. They don't understand why retail sales continue to be hot and inflation continues to go out of control. David Rosenberg's one of these bond bulls. Tough to be a bond bull right now, in my opinion. So we'll see. They really need a crisis to occur due to not spending money. Coinbase gave up its lending practice plans and is getting into the NFT space. So that's coming down the line. And very good. Okay, great. So I'm going to go ahead and get ready to do the portfolio review now. So excuse me for one last little advertisement. This is where the video ends if you're not a paid member. And if you want to become a premium member or get a walkthrough of how to trade the program, John will take your call today through the weekend. Give him a ring at 505-610-1334. He's here in Albuquerque, lives just down the road from me, a great guy, and knows our product inside out. Okay, very good. So I'm going to end the free recording that we replay, and we're going to hop into the good information for paid members only now.